Where are interest rates going? Great question, and we get asked this all the time as corporate debt advisors. The next announcement is September 6th, the following October 25th, and then they skip a month into December 5th, December 6th. So there's 3 opportunities for the Bank of Canada to make their adjustments, and it's on everybody's mind. I'll tell you where rates are going to go, but let me remind you that economists, bankers, news writers have kind of missed the mark sometimes, and the forecast didn't all realize over the last year and a half. So it's important to remember that the data on inflation, immigration, GDP, population growth, and all the other variables that affect monetary policy are very complex and difficult to project. We didn't expect the commencement of interest rate hikes. We didn't expect the oversized rate hikes in the summer of 22. And it was a bit of a surprise when inflation numbers came in and we continued to hike back in July, 25 basis point hike. So I'll tell you where rates are going to go, but I want to share a little bit about what our team spends a lot more time on discussing with our clients. And that's really the tools and the strategies on managing interest rate hikes, interest rate risk. The one simple strategy and concept that I'll share with you today is something called debt laddering. It's piggybacking off of the concept of bond laddering used by credit institutional investors managing a bond portfolio. So if you can imagine a large sum of money being spread out over a multiple of duration of bonds, short and long term. And the purpose of this is to diversify, of course, and to have flexibility. So if you put a portion of your money into shorter term bonds, when that renews, in a high yielding environment, you're able to reinvest that into a higher yield. Now, on the flip side, if it's low, interest rate environment is low, yields are low, then you can roll it over into shorter term bonds so you're not caught in a low yielding environment for too long. So you can reassess your risk at each point, giving you more control. Now, taking that concept and moving it into borrowing money as a corporate commercial mortgage holder, let's say, an example of $10 million in debt against a commercial property, you can take that amount and apportion it over multiple terms. So say it's a 2-year term, a 5-year term, and a 7-year term. You spread it out over 3 different terms, and at the point of maturity, you can reassess where the yield curve is and make the best decision at that point in time. You can kind of avoid trying to make your best guess on what is the best term to throw all of your money into as a borrower. And really the purpose of this is, although it may take a little bit more thought, a little bit more time, it allows you to sleep at night. And this is something that we've never really, I wouldn't say never, but we didn't have to think about as much over the last, say, 10 years, because we've been operating in a very low interest rate environment, relatively steady. But now, with the volatility and the uncertainty of the interest rate market, it's something that we're talking about more and more.